Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I will talk about my process on finding the daily draw and trending markets. Traders struggle to find bias in the marketplace. They do not know whether or not tomorrow is going up or down. There is a simple process to finding the bias on the higher time frames. Stay tuned. Leave the indicators alone. This will be a three-step process, starting with core curriculum, chart activity, and lesson plan. Let's jump into our core curriculum. To begin, we must define what a swing high and swing low are. A swing high is a high with a lower high on the left and a lower high on the right. And inversely, a swing low is a higher low on the left and a higher low on the right. The swing high and swing low are the most two important formations I pay attention to. This is significant compared to everything else I know. What I'm going to share with you is my foundation to bias, whether I'm going to be a buyer or a seller. Let's say you see a swing high broken when we open our charts on the asset class that we're looking at. This is going to be a sign of bullish momentum, and a possible shift bullish is coming in the near future. Once a higher swing low forms after price breaks a swing high, you have more confirmation that the commercials are buying. Once you see a higher swing low, you can hunt for buy setups. When you place the two together, you come out with this buyer formula. Swing high broken plus higher swing low equals commercials buying. You now have more insight that the markets will reach for higher prices. Seeking buy setups will be favorable. Here we open our chart and we see a swing low is broken. This is signs of bearish momentum, and the underlying shift is bearish. Once a lower swing high forms after price breaks a swing low, you have more confirmation that the commercials are selling. Once you see a lower swing high, you can hunt for sell setups. When you take 1 and 1, you get the seller formula. Swing low broken plus lower swing high equals commercial selling. You now have more insight that the markets will reach for lower prices. Seeking a sell setup will be favorable. Let's walk through these two variables together in our chart activity. For our chart activity, we're first going to find a swing high or a swing low. After that, we're going to study what occurs after a swing high and swing low is broken. And third, we're going to think critically about what is occurring with the price action. Let's take a look at some examples. We're looking at Australian dollar versus the US dollar. And let's say today is now November 3rd. We are using what we recently see in price. We are normally going to take a stance when a swing high or swing low is broken. As of right now, we don't see either of the two occurring. But we can notice where swing highs and swing lows are. Can we find a swing high? Absolutely. This is a swing high. Now, why is this a swing high formation? It's a swing high formation because there's a lower high on the left and a lower high on the right. So this makes this a swing high formation. In order for us to be bullish, we want to see this swing high broken. Let's see what happens in the future price action. Here, we can see the swing high was broken. That tells us that there's going to be a momentum shift bullish. Ideally, we want to see a higher swing low form. Once this swing high is broken, in order for us to feel more confident that this bullish momentum that is occurring here, because breaking a swing high equals what? Bullish momentum. Now that may be short term or that may be long term, but this is how you catch the turning point. The swing high broken signifies to us that there may be future price action to the upside. But we need more confidence, and that confidence is going to come by way of a higher swing low. So we can see that this is a recent swing low that forms, and we're going to need one to form higher than that. Now, what makes this a swing low? There's a higher low on the left and a higher low on the right. We need this same formation to form, but higher in price, and not take out this swing low here. Let's see what happens in the future. Here we have a higher swing low formation. Now what makes this a higher swing low? Like I said before, there's a higher low on the left and a higher low on the right. At this point, we know that the commercials most likely repositioned themselves to go long. They started increasing their net longs within this 3-bar formation. After this, we have more confidence to be a buyer. And what do we see happen after this higher swing low plays out? We most likely will see higher prices. We play it out and higher prices is most likely expected. We can see after that higher swing low, price starts to rally. So you can go in with more confidence after this higher swing low to look for buy setups. And that's how I find my daily bias. odds are price action is going to look to draw towards old swing highs or previous daily highs. And you'll see on the left side of the chart, price action most likely is running out the buy side. After making that higher swing low, it runs to an old swing high. And as you can see, it gets really close here. If I were to play price further, I suspect it runs it here too. So it all started with this higher swing low to potentially expect higher price action. That's how I figure out if I'm a buyer or a seller. And then the daily draw gets a lot more easier with this formula. So we're still looking at Australian dollar versus US dollar for this example. Let's say today is June 8th, and this is all the data that we can see currently. We don't see a swing high or a swing low broken. In order for us to take a stance, we need to see one of the two broken. We don't see anything here, but we can mark out what we do see. We can see we have a swing low, and we also have a swing high. You have the formation all together in 3 bars. So you have a swing high here and also a swing low here. However, we need to see one side broken. That's then going to determine whether or not we're going to be a buyer or seller. Let's see what happens. We can see here, price breaks the swing low and doesn't break this swing high. So this immediately draws my attention and makes me think bearish momentum. This is going to be a shift to the downside. The commercials are most likely looking to go short. However, for higher confirmation and for me to feel confident to find short setups and for this bearish momentum to not be a false break and a true continuation lower, I need to see a lower swing high. We can see there's a recent swing high here. We just need the same formation to form below it and not take out this high. What makes this a swing high? There's a lower high on the left and a lower high on the right. We need to see the same formation form, but lower. Let's see what happens in price. We can see price trades down. And here we get a swing high formation. 1, 2, 3, because it only takes 3 bars. It doesn't take 4 or 6 or 8. It only takes a 3-bar pattern. You can see it's a lower high on the left and a lower high on the right. That makes this a swing high, and it's lower than the most recent one we had after breaking a swing low. So this gives me more confidence that the market should most likely seek lower prices. The commercial speculators are repositioning themselves short. They're increasing their net shorts in this swing high. And we can play it forward to see what occurs. And ever since then, we can see the price action is drawing for previous daily lows and is not necessarily trying to run previous daily highs. And that's how I project lower price actions if I'm going to be a seller. It all started with this. Next, this. So it starts with a swing low broken, then a lower swing high. Moving forward, I have more confidence that AU is most likely going to drop lower. What is it most likely going to aim for? Inversely, it's going to aim for sell side liquidity below old swing lows. We can see there's one here. And if you zoom out a little further, I'm not sure if there's any on the left side, but we can see there's one here as well. There's a swing low formation here. We can see it takes it out there. And the price action keeps breaking down. That's how you figure out whether or not your daily bias is going short. For this example, we're looking at British pound versus US dollar, and we're looking at more recent data as well. For those that know, I was doing my daily updates for March on GU, and we're going to use that same analogy that we learned today to find bias and see how it played out here in this market. We can see the market is going up, but what starts this uptrend? It had to be a shift in price. Where does that shift occur? We can see it occurs right here. That's a swing high formation. Let's bring it right back to that swing high when that swing high is first broken. Right here. That's a swing high formation broken. What does that tell you, guys? Momentum may be shifting bullish. Now, when you see this, it works out beautifully with all the other confluences that I've been showing you over the month using IPTA, using the opening price, using the bias of Sunday's opening price or the session's opening price. This is how it all blends together. Price breaks a swing high. What do you have to do now in order for it to be confident to go buy? Wait for that higher swing low. Where does price give us the higher swing low? Right here. 1, 2, 3. There you go. Now, that doesn't mean the swing low is going to form immediately, because price could break this swing high and continue trending up for a pretty long while before giving you a swing low. But if the market makers are going to make a retracement, it's going to be made with a higher swing low. There goes your retracement phase after breaking out of a consolidation, going into expansion, retracing back down, and then making a new expansion going higher. What do we see after that? We can see price continues to move higher. What occurs here after taking out this swing high? Most likely a higher swing low. This is another swing high that forms here. 1, 2, 3. That's the swing high here. Price breaks it. What do you have to do to go long? Wait for a higher swing low to form. Let's see what happens after that. What is this? 1, 2, 3. That's another higher swing low. And as you can see, the market makers just keep buying it higher and higher and higher. And what occurs after this higher swing low? Most likely more buying. And that's where we are in price. For those that knew I was tracking GU, I was also using an intermarket analysis comparing it to DXY since they move inversely. We can see that the DXY is down here in most recent time. But what made us get down here? Odds are it was some type of shift up here, a false break or a shift. We can see that there's a false break above this swing high here. And after that false break, we come down and break what? A swing low formation right there. That swing low formation starts the equation. Oh, are we going short? Possibly. But what are we missing? We're missing one variable, a lower swing high. Let's bring it back to where that swing high was broken. So right here is when that swing high is broken after giving us a false break here. What are they doing to retail traders here? If they're breaking a high and then running back down and breaking a swing low, most likely they're just taking out the buy side liquidity above this high and running it back short, changing the trend in the market. But what do we need to be more confident? A lower swing high formation. And we can see we have it here. 1, 2, 3. This is a lower high formation. That's the higher swing high. And this is the lower swing high. This is now giving people more confidence to go short in the market. But what is occurring here? If we had to talk about this critically and talk about this as informed traders, I would say that the commercials are increasing their net shorts. So they're actually selling in this up close candle. While it looks like it may be coming back strong, it is actually going to be the commercials selling stronger than they're actually buying. Price is now going to break down after this up close candle, making the lower swing high. I could be more confident for lower price action. Where I'm going to aim for is going to be old swing lows or previous daily lows. Previous daily highs will be protected. And if previous daily highs are ran, it's most likely just a run on buy stops to then run lower, or a run on buy stops to convince retail to get out of the shorts and go long. We can see some old swing lows in the market. We have one here we'll mark out. We also have one that's all the way down here back in February that we'll mark out. So at this point, you're going short and you have some ideas where price most likely would reach for after getting the lower swing high. You can press play and you'll see what happens. Price takes out previous daily lows and does not want to take out the previous daily highs. If they were to take out the previous daily highs, odds are it's just a buy stop raid to get retail traders to get out the shorts and go back long, to trick them up psychologically again. but we know overall it's most likely going to keep going lower. And that's how you would play that out. And you can see we have a lower swing high that forms after taking out what? A recent swing low here. 1, 2, 3. That's a swing low that was broken. It also breaks an old swing low. What can be expected after breaking a swing low? Maybe a retracement of a lower swing high. That's what occurs here. This is all what the markets are made out of. Swing highs and swing lows. They determine the market. These two patterns in price. That only takes 3 bars. So if you're looking at it on the daily chart, it's a 3-day setup. If you're looking at it on the weekly chart, it's a 3-week setup. If you're looking at it on the monthly chart, 3-month setup. If you're looking at it on the yearly chart, it's a 3-year setup. Normally the markets are being changed in trend in 3 bars. That's always going to be found logic. Nobody else can tell me different. And now that you have this information, you have no excuse to not find daily bias now. And that's where we are currently in price for DXY. So your main takeaways from this video is going to be the ones that follow. If bullish, wait for a higher swing low to form. Now that's only after you see a swing high broken. And vice versa, if bearish, wait for a lower swing high to form after a swing low is broken. You need to see the swing low broken, then the lower swing high. Then you go short. And third, as an added bonus tip, wait for the third candle in the swing formation to break to have more confidence to go in short or long. And I'll show an example of that now. Looking back at the dollar example and looking at where the swing low broke and we got the lower swing high, look at the third candle in that lower swing high and see what happens next. So if we were to take everything off, take this off so we're not focused on everything else. The third candle in this swing high is here because it's a 3-bar formation. That's the low of the candle. If this candle is broken, then I have more confidence immediately going in short probably the next day or the following day. You'll see that price breaks that low. Now I should be confident enough for price to take out and have a high probability raid on this sell side liquidity at the previous daily low. So the next day it should run that low. And then moving forward, the trend should continue. And you'll see previous daily low broken after one another. That's how I like to play the market out. And it continues. Now inversely, it will look like this. So we go to British Pound USD. So here we can see the higher swing low here after breaking that swing high. Now I know you can see on the left, this was a false break. Odds are price action came down to take out the sell side liquidity. And you can see how it quickly runs back up and takes out a swing high. Then creates the higher swing low. That's the third candle's high that we're looking at in that formation. So right here is that candle's high. And odds are, if we could get this candle's high to be rated, we could then be more confident to go long in the market. Let's see what happens next. You see it runs that. So then I know I have a high probability buy stop raid on the previous daily high. So the next day I could look to go long. And we can see price runs through that. And then it may even run through this one as well. And you can catch a trending environment like this. But like I said, it all starts from the break of a swing high or swing low. And what happens after that break is truly the turning point. That's here. It's a little more advanced to catch this, the false break. Most traders may not understand how to catch this move here and then come up here. But once you see a false break like this, price breaks a swing low, but doesn't give you a lower swing high. Instead, it takes out a swing high. Odds are it's probably just a false break and you're going to look for the higher swing low. And then price should take out previous daily highs. That doesn't mean every previous daily high it's going to run. You can see here, next candle is down. But are we still a buyer? Yes, because of the overall trend and the idea that we're going to supposed to run for higher prices or old swing highs. Something higher in the marketplace. And you'll see the next day, odds are it runs the previous daily highs. And you can see it takes out that candle's high. We'll zoom in. This candle's high here and the one before it as well. And that's overall what I do to find the bias in the marketplace, especially on the daily time frame. And as always, it's fractal. You can use this on the weekly as well. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoy this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.